बॉम्बे में तो ठीक है, दिल्ली तो एकदम हॉट है।
दिल्ली तो काफी।
Madam, thank you so much. Warm welcome and a very good afternoon to all the participants here today for the session on Schedule 3 and Clausewise analysis of CARO. Today, we at Pune branch, I along with my colleagues in the committee, Pranav, Rushikesh and Sachin, welcome you all. We are fortunate to have with us today our Central Council member CA Durgesh Kabra as a keynote speaker, and we have this session scheduled for 2 days. So to kickstart with the session, we start with our tradition, the motto song. So may I please request the admin to play the motto song. To all the participants, I request to place your hands on heart while the motto song is being played.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चनात्यति कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you so much. With this, we would like to share the upcoming events happening at the Pune branch. It's indeed a moment of pride and privilege for here, the Pune branch, that we are hosting the regional conference, which is happening for the first time outside Mumbai. It's a signature event of the entire region, and hence we request you all to please join us in big numbers and make this conference a memorable one. We have a galaxy of top-notch speakers lined up, and the sessions would be happening in the physical mode on 3rd and 4th of June. So we have a short video which has been prepared for you to have a glance that this is going to be a memorable event indeed. So please have a look at it, and today is the last date for the early bird registration. So don't miss out this opportunity. We welcome you all and eager to welcome the participants across the region. So Reshma madam, please if you could place the VC. Thank you so much for that glimpse. I'm sure that definitely this interesting session lined up with the keynote speakers and the panel and the galaxy of the top-notch speakers, we definitely will be gearing up for becoming a future-ready professional. We at Pune branch are gearing up for welcoming you all in large numbers. So please do participate. Thank you so much. With this, I request my colleague Sachin Miniar to welcome our keynote speaker for the day. Sachin, over to you.
Yeah, thank you, Amruta. Good afternoon, everyone. I, on behalf of entire Pune branch over here, welcome our keynote speaker, CA Durgesh Bhai Kabra. He is Chairman Committee on Insolvency and Bankruptcy Code. He is also Chairman Financial Reporting Review Board, Convener Center for Audit Quality Directorate, Member Quality Review Board, Director Indian Institute of Insolvency Professionals of ICAAP, and member of various other boards, committees like ASB, VSB, DTC, ESB, etc. CA Durgesh Kumar Kabra is senior member having an extensive experience of more than 30 years in company law, corporate structuring, management advisory, audit and assurance services. An avid speaker and an expert in law and bankruptcy code, he has addressed more than 180 seminars, forums and conferences on company law, LLP, insolvency and bankruptcy code, and standards of auditing. A strategist and leader to the core, he has conceptualized and implemented many initiatives at WRC during his chairmanship. As an active and responsible member of trade industry, he is associated with various social forums as well. With this very short and brief profile reading of Durgesh Bhai, I once again welcome Durgesh Bhai and really thank him for sparing time from his busy schedule and to have joined us to give the keynote address over here. So over to you, sir.
Thank you, Sachin. It's indeed a pleasure to be a part of the 2-day series on Schedule 3 and CARO. Pranav Apte, Treasurer Pune branch, Sachin Miniar, Managing Committee member of Pune branch, Amruta Kulkarni, Managing Committee member of Pune branch, Rushikesh Badwe, the Managing Committee member of Pune branch, and Chandan, Lahoti, Harsh Agarwal, who are going to be the speakers for these 2 days, which are very important for all the auditors who are doing the corporate audits. I mean to say company audits. And it is with respect to the Schedule 3 as well as with respect to the CARO. Friends, let me tell you, as we talk about future ready CA, if we don't understand Schedule 3, which is new one, completely revised, as well as CARO 2020, which came in 2020 and was supposed to be applicable from 2020, but it has been postponed for 2 years. The reason being that the amendments which were made into CARO, the amendments were such that if you start asking the informations from the management, which are there, on which you need to report, it becomes very difficult. And the client will tell, find out, take and report. If it is negative reporting or qualified reporting, then there are further more questions from the client side. So we thought at the council and we discussed with the Ministry of Corporate Affairs, whatever you are saying us to report on the various aspects which are important one, if the same are being added to the Schedule 3, then getting the information from the management and from those charged with governance, it will be very easy. And we would be in a position to give our transparent report, and the readers of the financial statement users of the financial statement will be able to take the same in a very right spirit. And that's how on representation, the ministry thought of it, understood our concern, and Schedule 3 was revised. Now, friends, let me tell you, Schedule 3 is a complete responsibility of management. CARO is responsibility of ours as auditors. But I believe today the participants are from both sides. They are preparator also, and they are auditor also. Some may be from the companies where they are preparing the financial statement, and some are the practicing chartered accountant. And friends, let me tell you, why all these kind of clauses have been added? Because in past, some of the years we have seen that there are a lot of frauds, a lot of misstatements in the financial statements, which has created a lot of trouble and financial losses to the treasury of the government. I would say indirectly to the treasury of government, but directly to the banks, financial institutions or so. Because they have gone into the IBC, they have gone into the insolvency resolution, they have gone into the liquidation, and lakhs of crores have been vanished. That was the reason where government thought, because of IBC, all these have come into the knowledge, insolvency and bankruptcy code has come to the knowledge of the government, and how to stop it out. That's why the CARO brought. And CARO is followed by revised Schedule 3. And when this has been decided, the changes have been done in Division 1, 2, and 3 all. 3 is applicable to NBFC, and 2 are for AS and Ind AS. 1 and 2 are for AS and Ind AS. So in detail, these two speakers will be dealing with all of you. But let me tell you, friends, our duty is most important as an auditor. If we perform our duties judiciously and ethically, let me tell you, my dear friends, my dear members, that no one can raise fingers on you or us. And we would be in a position to report in a right way. And once we report in a right way, transparent way, then it makes the difference. The stakeholders get the right information. Maybe government, maybe ministry, maybe shareholders, maybe regulators, maybe SEBI, maybe RBI, or Ministry of Corporate Affairs. All will look from the different eyes, and they will appreciate that the chartered accountants have done their job in a best way. So it is our duty to see that we perform all the checks and balances and maintain the audit quality. We use SQC1, which is the mother standard of the auditing. And with the help of that mother standards, we have all the policies laid down in our firm that yes, how the audit is to be conducted, who should be made responsible, how the review is to be done, how the rotation of partner will take place, how independence will be made, how the various threats will be taken care of, what kind of technology we are going to use. These are the various things which we need to take care. And not only this, we need to see third-party confirmation. We need to see physical verification. We need to see physical verification of assets. And all these things which have come into the new CARO and the new Schedule 3, just to see that the money has not been used in a different way and has been used for the purpose for which it was raised. CWIP, capital work in progress. Now you have to give the details in year-wise details for completed, for non-completed, accomplished and non-accomplished project. That will make difference. Since how long you are showing this as capital work in progress. Same way, debtors, creditors, you have to give the aging schedule for both of these. This is going to make a lot of difference. 3 years, say suppose somebody is not taking money from you, why that fellow with the trade payables, whose name is there in the trade payables, why he is not asking? Today, even a brother gives loan to his own brother, then he'll ask after 6 months or 1 year, whatever time is decided, that please give me vaya my payment. I had given you on that particular day. But 3 years, nobody has asked. There is no communications. So what other kind of procedures you have to adopt for finding out the facts, whether this was a bogus purchase or not? And if this was a bogus purchase, how it is affecting the true and fair view of the financial statement. Likewise, debtors also. 3 years old debtors, 2 years old debtors. Normally, 30 days to 90 days का पीरियड जो है वो रहता है जो क्रेडिट अवेलेबल रहती है. But sir, when it becomes 3 years, 2 years, then it is a questionable. Nobody gives you on that much credit. So you have to have the questions from the management. And if they don't reply, you have to use another techniques and proceed further for the audit. So you comes to know that whether these were the bogus sales or what. So there are many changes. And one more important change which I feel is the end use of the money which has been raised by the firm. So if through the subsidiaries, through associates, and through some other concern, if the money has been used for some other purpose, whereas it has been taken by the company and has been used by somebody else, then it is not right. So end use of the money is also required to be established. The learned speakers will explain you all these provisions. But friends, let me tell you that these financial statements are going to be much better as compared to what we were reporting earlier, because there is a lot of responsibilities casted on the management and simultaneously on the auditors too. And when auditor will be reporting where the data are already being analyzed and made available by the management in a particular format, then it becomes easy for all of us to report in a proper way. The CSR are the other provisions where if the amount has not been spent, all these details are required to be given. Why, when, there are certain questions in case of CSR spending also, which is required under Section 135 of the Companies Act. That is required to be given. So friends, all these new clauses under the CARO, which have come, or in the Schedule 3, which has come, will bring much better corporate governance and also help chartered accountants to perform their duties in a judicious manner with the help of all the standard of auditing, which are 46 M numbers, I must tell you, 38 plus 8, 8 are the review standards and 38 are the standards on auditing. Probably many of us doesn't know how many numbers of the standards on auditing are there. So I've given you the numbers. At least we must know this, and then one name. So we at the Center for Audit Quality have started a series of quality cafe. Our first was on the SQC one. That was the most important, and we have discussed that one. Then the second is on audit documentation. First one was on the independence, sorry, and second one is on the audit documentation, which is going to be on 28th. It is a VCM, which is freely available to all the members. Can join it. Documents the savior of the auditors, as well as it was independence earlier. These are available on the YouTube also. You can go through it, and how it will help you to have the best of the documents made for yourself by you only, which helps you when something wrong happens in the financial world, in the corporate world, and you are also involved into it, then it helps you out. So, friends, it is my humble request that you must understand the importance of Schedule 3 and CARO 2020, report judiciously, and there should not be any compromise. Please even educate your client. Yes, this is the requirement. If we don't do, you will also be into trouble. We will also be into trouble. So explain them and they will also understand. The time has gone when the things were seen differently, but time has completely changed. Now the things are seen in a different way and is being taken also in a different way. So my humble request to all of you, please adhere to whatever is there in Schedule 3 and CARO 2020. See that you report on all 21 clauses of CARO 2020, of which 20 are applicable in general to the companies whom the CARO is applicable, whereas one clause number 21 is applicable in case of the consolidated financial statement only. So friends, I wish all of you a very happy learning in these 2 days, and I'm sure that Chandan and Harsh will take you through all the provisions of Schedule 3 as well as CARO 2020, because there are overlapping provisions. 2020, when we are talking of the Schedule 3, simultaneously what are the reporting requirements in CARO 2020 can also be discussed. So CARO 2020 and Schedule 3 taking together has become mandatory nowadays, and it helps also to the speaker and to the learner, both sides. So with this, thank you Pune branch for giving me an opportunity to be part of this wonderful initiative taken by Pune branch under the leadership of Kashinath Pathare and guidance of Sri C.V. Chitaleji. Thank you all, friends. Thank you very much.
Thank you, sir. Thank you very much. So now I hand over to Amruta for further proceedings. Over to you, Amruta.
Thank you, Durgesh sir. We really can't thank you enough for this initial opening address, and definitely we will adhere to all the pointers which you have given in this session. We are equally eager to hear from Harsh and Chandan. But what Kabra sir has said, that definitely this 2-day full sessions are going to be of great help for the upcoming audit season for everyone. So we really thank you and look forward to welcome you for other sessions also. Thank you so much. Our pleasure to have. So you're
coming to Pune in regional conference.
Yeah. Please, eager to welcome you, sir. Thank you. And now, yes, our actually enthusiastic speakers, passionate trainers for the day, Chandan, Lahoti and Harsh Agarwal, they really don't need any introduction when it comes to the Pune audience, because they have taken up interesting sessions in the past on audit quality maturity models and many other interesting sessions also. And when it comes to interactive sessions, they are equally enthusiastic to make some poll questions and have some panel discussions. This time also they have come up with the interesting questions for the entire audience to engage them throughout the session. So I request all the participants to stay glued to the screens and also keep your keyboards ready, because we are having some poll questions. Interesting poll questions would be there, and then that will make the session more interactive. At any point of time, the Q&A panel is also open for you, so that will help us to facilitate you much better. I request my colleague, without wasting much of the time, that I request Rishikesh Badwe to introduce the speakers formally, Chandan and Harsh. Over to you, Rishikesh.
Thank you, Amruta. As she has mentioned, that both the speakers do not really need any introduction, as they have taken very interactive and interesting sessions in the past. But it's my pleasure to introduce two of the most learned faculties of this topic, CA Chandan Lahoti and CA Harsh Agarwal. Chandan is a partner with Ahuja Walesha and Associates and is responsible for corporate development and strategy. Before this, he was with SRBC and Company LLP for last 15 years and was servicing as director with SRBC Pune branch and specialized with statutory audits. He has worked on audit and assurance engagements of large multinationals in India as well as overseas. As a part of SRBC, he has led and managed audit of large listed entities, including the likes of Cummins, BFL, Eaton, etc. He has worked on diverse industries, right from heavy engineering, automotive, IT, and also startups. Though Chandan has worked in audit and assurance domain, he equally has great domain knowledge in direct and indirect taxation. He is very active on various industry forums like MPF, MIG, etc. He likes mentoring fresh qualified chartered accountants and is a mentor with various groups across India. He has also been an active speaker on various topics at the SRBC India level and at ICAAP at different forums. Last year, he was WRC member for the Accounting Standards and Index Committee and was part of 3 ebooks launched by the WRC. As a person, he loves to travel, meeting new people, and helping community at large. I welcome CA Chandan to this 2 days seminar on revised schedule and CARO 2020. Harsh Agarwal is a post MCOM and FCA and has been qualified in 2009. He is a subject matter expert in the fields of audit and assurance. He has done audits under IGAAP, Ind AS, IFRS, and also US GAAP. Harsh is a fellow member of ICAAP and has an experience of a decade and a half in the fields of assurance and audit. He is a working director at SRBC and Company LLP. He has a varied experience in handling audits under Ind AS, IGAAP, IFRS, and US GAAP. He has also handled Ind AS and IFRS conversions in the past. He has working experience of various listed and private companies, including some of the promoter-driven and multinational companies. I once again welcome Harsh Agarwal to this seminar. And now, okay. So I hand over the charge to both the eminent speakers, Chandan Lahoti and Harsh Agarwal. Thank you.
Thanks, Rishikesh.
Thank you. Rishikesh.
First of all, thanks to Amruta to reaching out to me for the session, and definitely Overall, thanks to all the Pune WRC committee members, and thanks to Durgesh ji. He's like mentor to most of us when it comes to audit, and he has seen, I would say, over the period of last 30 years, auditing several companies, and I think so. We need to understand one thing. The request what he was trying to make to all of us is the time has changed. We also have to change. And now we need to ensure that the due to this Schedule 3 and CARO and various other aspects, we as a CA community, we need to gear up ourselves definitely to a further larger extent so that no one can finger point on us. So from there, I would just present my screen wherein we would discuss in detail about the changes in Schedule 3. I will just give a brief of a full day next 2 hours. So overall, between myself and Harsh, Amruta, you could see, correct, the presentations?
Yeah, it's visible.
Yes.
Okay, great.
Full screen
Great.
is there. Yeah.
Great, thank you. So overall, overall for next 2 hours, we will try to cover all the amendments in Schedule 3. Okay. We would be focusing on the IGAAP related changes in the Schedule 3. However, I would say 80% the changes in the Schedule 3, whichever has come under IGAAP and Ind AS are roughly same. So there are, I would say, additional 20% changes separately in Ind AS and separately in IGAAP. So what we have done, overall, wherever the changes are common, whether it's an IGAAP or an Ind AS, we have specifically covered that so that you get an overall ambit of an Ind AS and IGAAP changes what is there. Okay. Before going into this next slides, I want to just give some background of Schedule 3, because what I believe, out of 200 odd participants who are there today, there would be a lot of people who have freshly qualified. There would be few who have started doing the corporate audits in recent past. So overall, to give a background, what is Schedule 3? Because ultimately it is important to know what is Schedule 3. Then it's very easy to take the next steps. So overall, from a Companies Act perspective, Companies Act has defined Schedule 3, wherein all the disclosures required in the financial statement for the companies has been defined in Schedule 3. Okay. Schedule 3 has 3 divisions: Division 1, Division 2, Division 3. This is very crucial because as and when you go for an audit and you need to understand what is Division 1, Division 2, and Division 3. Division 1 is all the companies for whom IGAAP, when I mean IGAAP, Old Indian GAAP is applicable, or non-Ind AS financial statement, what we normally use the terminology. Okay. Non-Ind AS financial statement is Division 1. Ind AS financial statement is Division 2. Banking and NBFC and insurance is Division 3. Right now, we are covering majorly Division 1, but most of the items from Division 2 also would be covered. So overall, I would say most of the crucial disclosure where a lot of time is required by the management, by the auditor, we would be covering those in detail, including whether that impact require a small change in the financial statement or a bigger change required in the financial statement. Okay, that's point number 1. To all my fellow colleagues, I can tell you one thing. Schedule 3 has prescribed the balance sheet format, the P&L format, and it has further given in for all the respective schedules for each the balance sheet item and the P&L item, how it need to be disclosed. Okay. So one need to first understand that reading and understanding Schedule 3 is very, very important before starting audit of any companies. When I mean companies, it's a private limited company or a public limited company. When it's a private limited company, be it's a small company, medium micro company, or a large company. For example, whenever our fellow colleagues does a lot of tax audits, okay, definitely for a company, it requires a financial statement. And that financial statement is prepared as per Schedule 3 requirements. Okay, so I think so that I just thought of overall setting the context before we go into Schedule 3. All the if you have any questions, you can put on the chat box. In between the session or at the end of the session, we'll cover all the individual questions, whatever you have, and we'll try to discuss on those questions. So if you see this slide overall on the changes of Schedule 3, what I have done on my left side. On my left side, if you see, I have highlighted out of total changes required in the Schedule 3, the revised one, some of them are impacting directly from an accounting perspective and disclosure. And on the right hand side, it is only which impacts overall on the process of the company for preparation of the financial statement. Okay. Now coming to my left side, total there are 6 very high impacting areas. When I mean high, every company will have some or other implications with regard to these particular changes. And we'll discuss line by line item. And on the next slides, I have specifically mentioned which are the process ones and which are the accounting standard. When I mean medium, it might be applicable for some company, might not be applicable for some company, and the data collation for those changes, and also from an auditor's angle, whatever the changes we need to ensure is relatively not very high. And from a low perspective, it is just a changes in the words here and there at the balance sheet side or the P&L side or some of the notes to account side. Okay, so that's overall from a very high level. Going to the next slide, what I thought for next 5 minutes in crisp, let me give you a very overall high level overview. What are total changes? If one need to understand, and I try to cover everything in the slides. Okay, and for all the items we'll discuss in detail. So trade payable is something where aging would be required in the specified format for the trade payables. Okay, and which is a very crucial. It might have an implication whether you are using a Tally as a software, the companies, or any ERP is being used. I think so everyone is clear that even if the preparation of financial statement is a prerogative of a company and company need to prepare the financial statement, but as an auditor, if the financial statement are not prepared as per the revised Schedule 3, you need to suggest them what the changes are required, because ultimately as an auditor, we also sign the financial statement. So it is equal onus on the auditors to ensure that all the disclosure requirement as per the Schedule 3 are appropriately given in the financial statement. And when I mean trade payable includes detail with regard to MSME. Next item is with regard to trade receivable. Along with the trade payable, similar changes are done in a trade receivable from an aging perspective for current and non-current trade receivable, along with the disputed and undisputed trade receivable, if any, and the specific format has been prescribed in the Schedule 3. So this change is a very big change, and I would say this will require a significant effort by the company and the auditors with regard to the CWIP and intangible assets under development disclosures. So for example, if any company which has a CWIP as at their balance sheet date, or they have any projects which is an intangible which is undergoing Yeah. So all those details are required, and it is, I would say, it takes significant effort to collate those information, including some information, why it got delayed, how much it got delayed, when it would get start, etc. All those details would be required. Relationship with the stock of companies. So this is the onus on company in Schedule 3, and this disclosure is also required in CARO. So we will discuss whenever we do a CARO, what is a relevant disclosure required as an auditor from a stock of companies, etc. in CARO, but it has a consensus between the Schedule 3 and a CARO perspective. Loans and advances. Loans and advances which are granted to the promoters, directors, KMPs, jointly and severally, many disclosures are required. We'll discuss those in detail. Further, whether the loan is given by the company, whether the terms of the loan should not be the prejudicial to the company, and hence it should have specific details, whether the loan is on demand, whether the loan has a period, what is the interest rate, what is the term when interest would be paid, when principal would be paid. All those details would be required. Going to the next. Sorry, I'm having an issue with the view. Okay, now going to the lease disclosure. So with regard to the lease disclosure, the current and non-current portion of the lease liability need to be disclosed separately on the face of the balance sheet. CSR, I think so last 2-3 years we hear a lot on the CSR front, and I think so everyone might be aware that several months back there was an amendment in a CSR that the CSR cost, which was on an actual spend basis, the disclosure was done. Now it is on an accrual basis, and hence there are a lot of disclosures required from those angles, including if you have not incurred, then you need to deposit, etc. So this disclosure has a point with CARO, and again coming back to Schedule 3 perspective. This is a new change in line with, I would say, international reporting. We see a lot of IFRS related financials has these disclosures, and hence this is further giving more benefit to the reader of the financial statement, not only limited to the listed companies from a ratio perspective, but also from unlisted entities. A lot of ratios need to be given if there are deviation more than 25% from the current year and the previous year, and all those details are required. This is a change which one believe, oh, it's only a ratio, financial statement mein hum log number dal denge and we'll just present the ratio. It's not that, because at times the ratio gives a lot of different picture and color, and basis that a lot of things are required. So that way this is important. I think so overall, these are overall changes from a Schedule 3 perspective, which are the key ones. In detail, we'll go one by one here. If anyone has any question, and if you want to speak here, please raise your hand, and Reshma ma'am would unmute you, and then you can speak if anyone has. I'll just wait for 10-20 seconds, and if there are any questions, I'm happy to take those questions before we go into the next slide. Okay, Reshma and Prashant Prabhakar has raised his hand. Can you allow him? Can you unmute him?
Hello.
Yeah, hi Prashant.
Hello, hi. Chandan, I got one query. This is regarding a relationship with stock of companies. So we have to take the MR from the management regarding if there are any transactions with the stock of companies. Do we take a MR for that, or how do
no. Your question is on identification of a stock of company, or you are talking about there are transactions with the stock of companies, because both are different questions and different answers.
Disclosure requirements is for the company as per Schedule 3. So,
Yes.
So we need for the purpose of our verification, we need a representation from the management regarding the any transaction which they have done, because for auditor, it will be very difficult for us to identify the transactions which are the company which are struck off.
No, I think so, Prashant. 2 steps, and definitely we are covering that in detail in the next slides. First, as an auditor, you need to first identify all the stock of companies. There is a list available on the portal that which are the stock of companies. Okay. You need to get that list, and you need to cross verify with the trade receivables and the trade payable of the company. And you need to first identify whether the company is a stock of company or not.
Oh.
That is the first step as an auditor we need to do. Second, if there are few companies which are stock of companies and there are transactions, then as an auditor we need to disclose that. MR will not.
Thank you.
MR should so as an auditor we need to perform our procedures, and then we can just say in the MR that whatever is disclosed in the financial statement, this is a complete list.
Got it. Thank you very much, Chandan. Thank you.
Okay. Thanks, Prashant. Okay, we'll
So
go to
maybe,
the
Chandan, 1 minute. I want to spend 2 minutes on this slide before we go ahead. So here we have a lot of. Can you please unmute? Yeah. Okay. So on this slide, Chandan has very well covered the changes which are there in the Schedule 3. But maybe we can spend 2 minutes on see how this has an interplay in the CARO reporting as well. So like Durgeshji was saying that all this has a very big impact on the CARO reporting also. And one of the prime reasons of introduction of the revision in the Schedule 3 was because a lot of onus was put on us as auditors to report on various aspects of the companies. So few things here which are already covered from a financial statements perspective. We as auditors also have to opine and give an independent view on whether. So to take an example of the stock of companies, there is a clause in CARO which says that as an auditor, you have to comment whether there are transactions or not. So again, going back to Prashant's question, whether a management representation only will be sufficient or not, because it is not only a disclosure in the financial statement. You as auditors have to make a black and white comment whether yes or no. So if, for example, the company is unable to identify anything as a transaction with a stock of company, and as financial statements belong to the company, they may choose that they do not make any disclosure. But if you as auditor have done your audit procedures and you find out that there are some transactions with such companies, so as an auditor, it's your duty to report those transactions in the CARO reporting. So likewise, there is a big interplay between the CARO and the Schedule 3, wherein whatever is given in the financial statement, you as an auditor has to make a comment. Coming to taking the example of a key ratio, somewhere in the CARO, you have to give again in a way a black and white opinion whether the company will be able to meet its liabilities for 1 year. So this is a very onerous and a very dangerous clause wherein tomorrow what will happen nobody knows, right? There is a saying that kal kya hoga kisi ko pata nahi hai. So if the company themselves don't know what is going to happen, and making a futuristic statement in a way whether the company will be able to meet their liabilities or not is a very dangerous question to answer. Obviously, the ratio reporting was to do with something about the financial stability of the company. So for example, and obviously we'll discuss this in detail when we come to relevant slides, but some of the key ratios that are coming up in these financial statements are, say, for example, a debt equity ratio. So if you see that the overall debt in the financial statement is too large for the size of the company or the size of the size and operations of the company to honor those debts, obviously then you as an auditor will have to make a negative comment that you are not able to comment on that. But if the debt is in acceptable ranges, if the ratios do not indicate any red flags and similar things, then it is obviously possible for an auditor to make some comment on the future viability or on the future liabilities of the company. So likewise, there is a big interplay. We have a separate session on CARO also. So as it is a 2-day event, today we'll try to cover the Schedule 3 changes. Tomorrow we'll go on to CARO. But where there is an interplay, we will just try to interlink both the things. Similarly, CSR again, CSR also you have to comment in your CARO reporting whether the new changes in the CSR, which is deposition of the unspent amount to the respective bank accounts, whether it belongs to a project or doesn't belong to a project. So again, this disclosure you will have to audit as an auditor and again opine it in your CARO reporting. So some of them are very important, and hence even from a financial statement perspective, we as auditors will have to become very vigilant and very specific in terms of ensuring that nothing goes misrepresented in the financial statement, whether material or anything.
Thanks, Harsh, for your inputs. Next is, I think, so we have a poll question. Rishma ma'am, can you just?
Sorry.
There is a poll question next.
Okay.
Hello.
Yeah.
Sir, this is Niranjan, and I have a question related to the disclosure on disputed and undisputed receivables and payables.
Niranjan, the next slide is on the same question. Once I complete that slide, if still your question is unanswered, you can unmute and speak. Is that okay?
Okay.
Thanks, Niranjan.
My question is on identification. If you can cover that, that will be helpful.
Yeah. I will cover. Thanks. Yeah, I think so. Poll question is on the way. We could see 18, 19 participants already given their answers. We'll just take some more time. We could see most of you are tilting towards original date and not date of acquisition. Let's see what would be the right answer. We can wait more 10 seconds and then we'll end the poll.
Hello.
Okay. So overall, if you could see, most of you believe that original date, and I think so the answer is correct, because from a consolidation perspective, whenever you take when you acquire the company, the debts which need to be disclosed for those respective companies would be from the date of original initiation of the transaction and not from the date of acquisition, and that's correct. So, okay.
So 80% of you guys have been answering correctly.
Yeah. So I will next two slides in detail. I would cover on trade receivable and trade payable, and when I mean trade receivable and trade payable, majorly on what are the changes and how those changes would be disclosed, etc. So as you are aware, the current practice, I will not go into a detail about what is the current practice with regard to trade receivable, and you would see for the next full 2 hours, we have segregated each disclosure in 3 parts. First, what is the current practice? Then what is an exact amendment? And if the disclosure is prescribed in the Schedule 3, we have displayed that disclosure as is. And then the key consideration, where as of now, one could say it's a gray area or black and white answer is not available in the Schedule 3, neither in the guidance note. Overall, I could say from the series perspective, last year in 2021, revised Schedule 3 was announced. Coming to several months after, there was an I would say from an MCA perspective, there was a report wherein, or rather not MCA, Institute, wherein Institute has clarified that this is Schedule 3, this is CARO, and how in sync you should read that. Okay. In addition to that, in Jan 2022, from an institute perspective, the guidance note on Schedule 3, which was earlier available, they revised it and they included a lot of items what are being covered in revised Schedule 3. Most of the items has been clarified in the guidance note, but post guidance note, there are many queries being discussed, and I would be discussing those queries, what I could hear from industry and a lot of forums, that these are the few questions which are right now unanswered and how we should go ahead on that. So currently what Schedule 3 has done, in addition of the existing requirement, current and non-current trade receivable aging schedules is required. And if you see on the right hand side of the screen, these are the particulars what need to be given the schedule, and these are the aging buckets. So these age buckets has been prescribed in the guidance in the Schedule 3 itself. So we need to follow this disclosures. However, some things which is not been clearly specified is in case where there are no due dates specified. In that case, disclosure should be done from the date of transaction. This is what is coming out from the guidance note, but this is not specifically mentioned in Schedule 3. Next is what to do of unbilled dues, because there would be an unbilled dues which is not been billed. So from an unbilled dues perspective, specifically nothing has been mentioned in the guidance note or in the Schedule 3, but if you believe that the unbilled dues are aged items, then this disclosure is always better to give, because otherwise the reader of the financial statement and the intention of the changes in the Schedule 3 would get defeated. Okay. So that's overall, I would say, from the trade receivable perspective, but one could understand that it is a humongous task for the management to give the disclosure required under Schedule 3. And for that, company need to do a lot of things. And I think so I'm covering in the next slide, what are those changes which company need to take care to ensure that Rinkesh, just hold. I'll just cover the next slide, which is relevant from a trade receivable perspective. And then I think so I will allow you to speak. Is that okay?
No problem. Thank you.
Okay. So key considerations, which I thought, let me come up with some questions and give a clarification on those questions. Is the ERP configured to provide an aging analysis of trade receivable? Very important. For all the companies who are using an ERP, then ERP should provide exact details required in the Schedule 3. Otherwise, right now, the ERPs which companies are maintaining, the overall disclosure is as per their old, more than 6 months, less than 6 months, or how the management looked into it. Okay. Does the group, one company or various other companies, has adequate process to capture the credit period as per the customer contract? This means, for example, you have multiple customers, whether the terms of the customer, payment due dates, etc., is coming in the system or not. If it's not coming, it has to be ensured. Does the group has documented policy to identify the disputed receivables? How to classify a customer as disputed or not disputed? It has to be done as per the policy of the company. Otherwise, it's a judgment, and this between an auditor and an auditee, we will just debate, oh, this is a disputed or not disputed. It has to specifically mention, because nowhere in Schedule 3 or in the guidance note, what are disputed debtors has been explained. But from a layman's terms perspective, if between the customer and the supplier, the delay is only on account of some discussions or a delay due to the fund issues, etc., then it's not a disputed. Where a dispute is saying, the customer is saying, no, it's not payable, or customer is saying this is not payable because these are the conditions not met, then it becomes dispute. Otherwise, it can't be a dispute. Further, the most important part from an Ind AS perspective, whenever you do an expected credit loss accounting entry or review, one need to understand whether the aging report, whichever is coming from system, is aligned with the ECL policy of the company. Okay, these are overall few considerations what I thought. Rinkesh and others, if you have any questions, please raise hand and you can unmute and ask your questions. Pranav, I will elaborate on unbilled dues. Yes, Rinkesh, go ahead.
Good afternoon. Sir, in respect of this trade receivable, now many of our companies are maintaining accounts in Tally software.
Okay.
And even with respect to various customers, they have different credit period. And many times the same is not entered properly in Tally system. So how do we identify this edging? I mean, should we rely on MR only?
No. MR is not correct approach. In this case, you need to ask management to 100% make changes in their Tally system, the term as per the agreement, as per the PO.
Okay.
Then it has to be removed. Otherwise, you are giving a wrong disclosure.
Okay.
Okay. And hence, I would say a lot of efforts would be required by the management, by the company, and we need to guide them because at times they might not be educated. But as an auditor, we can definitely guide them that these are the Schedule 3 changes and you need to start making those changes in your system, etc. Then the correct aging report will come. I think so. Pranav and Dhananjay has some questions and I will answer that. What is unbilled revenue, unbilled dues? So at times in be it a manufacturing company or EPC company or a service companies, revenue is recognized because all the terms and conditions of the revenue is fulfilled, but it's not invoiced to the customer. And it sits as an unbilled revenue under in the balance sheet. Okay. Hope Dhananjay have answered what is unbilled revenue. And please elaborate on unbilled dues. I think so that Pranay, you had the same question. Pranay and Dhananjay, if you are satisfied with the comment, you can just put on the chat box that it's fine. Or if you want any further elaboration, I can do that. Okay, if there are not, whether to include unrealized foreign gain loss as part of aging of trade receivable and trade payable. I think so. Very valid question. But as you're aware, whether it's a Tally or it's a any ERP, they have a separate GL and a sub GL, and the trade receivable balances is in sub GL, and the foreign exchange gain loss sits in the sub GL. Okay. However, from an overall perspective, if you need to disclose the overall balance, because the overall balance should also match with them, in that case, it need to be clubbed under respective trade receivable. Otherwise, the amount as per the trade receivable schedule and the amount which is coming in the aging report will not match. I think so. Hital, you understood what is the problem and why we need to ensure that it matches with the financial statement. And that is a practical problem what has been encountered in April and May audits, which has been closed recently. Do we need to insert new column for the unbilled revenue and debt? No, unbilled revenue is not disclosed under trade receivable schedule. Unbilled revenue is disclosed under other current assets of the financial statement. There you need to disclose a separate table or you need to give more details. Because unbilled revenue is not trade receivable, it's a other financial asset. If it's a financial asset. Okay. Okay. Going to the next slide.
Okay, Chandan, I have few more questions for the audience. Good. Because many questions have been covered. I thought of covering a few more. So can you go to the previous slide just to see what is the requirement, and then people will be able to correlate. So generally, what I have seen that when there is a trade receivable and the companies do accounting for receipts, it is not always necessary that there is a back-to-back matching of whatever was billed and whatever is collected. So for example, if your client or if your company has raised an invoice of say 10 lakh rupees and the customer has paid not 10 lakhs, suppose they have made a part payment, or in other words, even if they have made a full payment, many customers do not give advice in terms of against which invoice this should be knocked off with. So in this typical case, many companies do not adjust the original balances, and there is a debit balance and there is a credit balance in the same ledger against the same party. So if you see, if there is this hygiene, if not maintained by the company in an appropriate way, what happens is that the aging gets distorted, where it is possible that some age buckets will give you a negative balance because there are receipts which are sitting in non-due category, for example. And at the same time, there would be some receivable sitting in, say, a 6 months bracket or a year's bracket. So it is very important for companies to do this knockoff, or if the knockoff is not done at a reporting date, we as auditors will have to ask the company against which invoice this knocking off should be done. This was a practical challenge that we had faced, and hence inappropriate reporting was getting reported. We obviously told the company to get it rectified and then change it. So I thought of sharing this practical insight. Second, one more insight was how do you identify good debtors? So there is a disclosure requirement of those debtors which are considered good. So again, you can check with your clients, are there any sales against letter of credits, or are there any secured sales as such, wherein sometimes the bank directly pays to the company and in a way it is secured, or sometimes there are advances. The company has a policy of taking advances before selling. So these should be appropriately knocked off or showed under good debtors. This is again, sometimes we miss, even the company do not disclose, because this is nothing, all these things are not coming in the trial balance as such. These are sometimes off balance sheet items, or even sometimes off balance sheet information, which we should be aware of. I think these were the 2 points that I thought would be relevant to the group.
Okay, thanks, Harsh. Anyone has any question before we go to the next slide? If not, I'll go to the next slide. Okay. So with regard to, I think so two of you have raised hand. Harsh, can you just see their names? CA Siddharth Inamdar, can you unmute? Siddharth, you can unmute. Reshma ma'am, can you help us in unmute?
Yes, please, because even I am not able to see exactly who have raised hands. So that...
Sir, can you hear me?
Yeah, I can hear.
Yeah, so this is regarding the disputed and undisputed trade receivable. As you have mentioned that there should be some accounting policy with the company, and based on that policy, the company should evaluate and analyze the credit risk, and accordingly they should find out whether there are any disputed trade receivables or undisputed trade receivables. So the question is that many a times these small companies do not have these policy in writing. And as an auditor, what else we can do from our side to verify the information provided by the company to us that the disputed receivable versus and undisputed receivables is reliably correct?
So Sunny, correct, Sunny is
yeah.
Sunny, what does policy mean? So we have a very wrong interpretation. Policy means it has to be a several pages, all need to be. So policy can be even a small half-page document which company is maintaining. Okay, that becomes your audit file paper, or from a company perspective, that becomes a policy. When I mean policy, it should state how they want to identify the default trade receivables.
Right.
Correct. So what we need to suggest to client in such case, and I've done for a lot of smaller clients, is draft something which is just 1 or 2 paragraphs and define that with regard to disputed trade receivables, this is something what we will follow and will follow consistently. So as an auditor and as a company, as a Schedule 3, as an NC, everything, if you overall see, it says follow something consistently is important.
Okay.
And hence a policy document what I mean.
Okay. So is it not indirectly linking it to how we generally evaluate these receivable from
Yes.
whether they are good or they are doubtful?
Yes. Yeah. Sunny, it's in the same way, but it need to be. It's always better to have something in here because every company will have a different perspective.
Okay.
Every industry will have a different year. For example, it's a manufacturing EPC company.
Okay.
Having a receivable more than 1 or 2 years, it's a normal thing.
Right.
But if it's a manufacturing of some product, if it's more than 6 months, there is some issue. And hence, it's better always to be documented.
Thank you
Yes,
very
yes.
much.
And maybe just to add, Sunny, here are a few tips like Chandan was mentioning. You,
Right.
as an auditor, will always have some indication that something is going wrong. Suppose a client says that the receivables are more than 2 years and everything is good, for example, or everything is no, there is no need of a provision, for example, or nothing is disputed. So this itself is a misstatement in itself that things are not reconciling with the facts because
Right.
something is overdue for 2 years, something is fishy. So you will find some communication with from the company because nobody will leave their money, right?
Right.
So client will not sit like this without questioning or without having any communication with that party. So there will be some communication. Some people have an idea of doing, say, a notice to be sent legally, or involving a lawyer to recover the dues, or if there are checks, there are check bounces, 143, etc. Many things are there. So, so these are few indications where you can also tell your, obviously, it may so happen that things are not so organized, or you will not find anything and everything in one place, but you will have to do your necessary inquiry procedures and discussions with the management to find out what is the real issue in some of the older items to find out whether there is any dispute. Even if there is a normal notice which is sent out through a lawyer or through a court, which says that through a contract act, this was sold to you, you are legally bound to pay us. Something of that sort is also a disputed receivable.
Okay. Thank you very much.
Yeah, thanks. Going to, I think so. There is anyone because there were 2-3 hands raised.
Can you hear me, sir? I'm Siddharth Inamdar.
Yes, Siddharth, go ahead.
My question was basically around the disputed and undisputed receivables. So what I find missing is as an auditor, we are as it is bound to have third-party confirmations at least for major debtors. Okay, so what I find missing is the process of the company doing reconciliations with the debtors and creditors. I mean, if the company is doing that, so most of this disclosure in spirit might be, followed. So I would like your thoughts on this.
So Siddharth, I would bucket this into 2 set of companies. One, companies mandatorily having IFC requirement, ICFR, what we issue and report, and companies having not applicable IFC and ICFR. So first, to answer on the IFC applicable companies, as part of the IFC, as an auditor, we need to ensure whether the controls are in place. We need to test those controls and controls are effective or not. If reconciliations are not prepared on a regular basis and you see that this control is not passed, the assertion of various assertions for which we do an audit, we don't get a comfort. Okay, when I don't mean from number perspective, I mean from an IFC perspective. There you can suggest client that you need to follow this, otherwise we have to report it the ICFR. And I've seen companies following this once the regulation asks them to mandatorily do something which is important. Now coming for the companies which are smaller companies having revenue less than 50 odd crores, where IFC is not applicable. Okay. As an auditor, if you send a confirmation for the major balances and you receive the differences, okay, as an auditor, you can't stop there. For example, there are 100 trade receivables, you have sent confirmation to 50 trade receivables. Out of 50, there are differences in 20, correct?
Okay.
And you only ask the management to make changes for the 20 confirmations. The auditing standard on confirmation gives a clear indication, clear demarcations where we as an auditor can't stop there. We need to ask management to complete the procedure for all other trade receivables, and then only we can close the accounts. Because if out of 50 there are issues in 20, that means the balance 50 where you are not sent the confirmation, the chances of occurring an error is very high.
Yeah, correct. But doing
And
this
Siddharth, if you have sent confirmations to 50 and there are no issues in all the 50 confirmations, okay, then I think so legally and legitimately we can't push management to do that process.
Yeah, because doing this or trying to tell them or make them understand why this process is important would suffice our audit requirements also. Because
Yes.
if most of them for the SMEs we find that there is no process of asking for third party confirmations or rather reconciling accounts with them. So there, if that process is in place, I think most of these requirements should fall in place.
Agreed, Siddharth.
Absolutely.
Thank you.
So we could see some questions on the aging. Maybe I'll cover that before Chandan moves ahead. So there were some questions about the due dates and credit periods and etc. So let me clarify. So the requirement is that the aging should be based on the due date. So something which is not due. So for example, your normal credit terms are say 60 days. So it will form this amount will form under the part of the first heading, which is current but not due. Obviously, when it becomes overdue, that is it is 61 day or any period beyond the agreed terms of say 60 days. So that will then have to be bucketed between 6 months and year and so on. So there, I could see some questions on the chat box, hence I thought we'll just cover this.
So try to respond most of the questions.
Perfect.
Going to the I've done that. Going to the next slide, or I would say the next point. Once we have closed on the trade receivable, utilization of a borrowed funds for the purpose other than specified. Whenever company takes a borrowing, the purpose is specified in the agreement, whether the purpose is for purchase of fixed assets, whether the purpose is for working capital or any other specific. Currently, from a Schedule 3 perspective, there is no such disclosure required for such item. But from an amendment from a Schedule 3 perspective, whether the company has not used the borrowing from the banks and the FIs for specific purpose for which it was taken as at the balance sheet date, the company should disclose the detail where they have been used. That has been added in the, I would say, the Schedule 3. If you ask personally what disclosure need to be given, whether the guidance note has clarified, whether the Schedule 3 has clarified, no one has clarified. It totally depends what is a change. For example, if the company has taken a loan for fixed assets and used for a working capital, okay, there below the loan schedule, a detailed note can be given for the reader of the financial statement for what the loan was taken, what purpose it was used. From that perspective, and from a CARO perspective, definitely you need to give the details of loan which is taken from banks and not utilized for the purpose. There, as an auditor, we need to comment. So there is a linkage between three. Right now, what was happening as an auditor, we were commenting this in the CARO, but from a management side, this was not commented. And hence this change in the Schedule 3 as overall came. Okay.
So earlier, sometimes there was a requirement of a certificate or something. Now they are asking everything to be there in the financial statement.
Yes, simple. So bankers want certain. So most of the things management need to give directly in their financial statement. What is this is being overall ensured. Few things what you can add in the notes to financial statement is details of where they have been used, whether temporary it is kept in bank, whether the loan has been given to related party, what are the terms, arrangement with the related party, etc. How much is utilized, how much is not utilized, how much is not used for the purpose. That's all overall, I would say, from a disclosure perspective. This is a qualitative disclosure, what is to be required in the financial statement whenever you see this happening. I'll go to the next slide.
So any questions here?
So I have some which we'll discuss in detail. And then does the group have an effective loan management system to ensure compliance of above requirement? This is very crucial because whenever a loan is taken and loan is taken and kept in the current account, cash is fungible. Cash can be used anywhere. And it is very difficult to say whether the fund was used for a capital purpose or for a working capital purpose. But if you see the guidance note earlier on the CARO, we specifically said how to identify such case. For example, a company has taken a working capital loan, company has taken a term loan for the fixed assets. How to segregate whether the particular fund was used in which bucket when there is no proper tracker being maintained by the company. So I'll just give you a trick as an auditor. So for example, the company has taken a 10 crores term loan for fixed assets. Company has taken 5 crores of working capital loan. Company has a profit of 2 crores. Company has a cash profit of 5 crores. However, in the current year, the fixed asset addition payment in the cash flow is 20 crores. How much is term loan? 10 crores. How much is payment for the purchase of fixed assets? 20 crores. One could say I have generated this through my cash profits. How much is cash profit? 5 crores. So to the extent of 15 crores, you might give them leeway. But if the purchase of fixed asset in the current year is 20 crores, which is more than the cash generated during the year and the term loan taken, that requires a qualification in a CARO and a disclosure in the financial statement. However, if company is saying my cash is fungible and I've used my funds everywhere and anywhere, but if there are significant cash profits in the company, which are more than the current year purchase of fixed assets, intangibles, etc., from a cash flow perspective, one could still say it's not an issue. Okay. Next is, does group maintains a repository of filing documents to support such compliance? This exactly I was trying to say. If you say that we have not raised any fund and not misutilized, then some documentation or filings need to be done internally. And if breach of the contracts, etc., is also important because, for example, if a company has taken a term loan for purchase of fixed assets, and if you believe it is being used for some other purpose, if you see the agreement with the banks, it will have various clauses, penalty clause, repayment clause, interest clause, etc., if you don't use for the purpose. And hence this becomes an issue. And also the old Schedule 3, which was there earlier, requires a lot of disclosure in this regard. And hence that becomes very important. I could see one of you raising hand. Ma'am, can you just unmute them?
Hello.
Yeah, go ahead, Narendra.
Can you hear me? I'm Narendra Agarwal.
Yeah, Narendra, go ahead.
I just have one question. The current profitability or current cash profit whether it would be treated as a short-term short-term availability or for long-term availability.
So,
It is as per my choice.
So current year profit which is generated by the company. So correct. Now, for example, a company has taken, I will take the same example, 20 crores, 10 crores of term loan, 20 crores of purchase of fixed assets.
Yeah.
Okay. Purchase of, if company has not taken any term loan, how company will fund the fixed assets procurement? Through the current year profits, correct?
Yeah.
And current year profit is a cash which is generated can be used anywhere. We can use it for purchase of fixed asset. Rather, when I mean company can use it for purchase of fixed assets. Company can use it for purchase of raw working capital, etc.
Yeah.
So current year profit company can use anywhere.
Okay.
Okay.
Okay. Thank you.
Yeah. Anyone else before I go to the next slide? Okay. Poll question number 2, madam. Great. Let's go. Harsh, okay. I could see 50 of you has already attempted the poll question. What about others? Okay, I'll hold for next 5 seconds. Okay, I'll end the poll. Here I could see a mixed response. 42% says yes and 58% says no. Okay, I'll ask some of you to raise your hand and speak who has said yes. Yes. In such cases, such adjustment would be treated as discrepancies. Either of you can just unmute and you can give a rationale why you say yes. Anyone want to give a try? Okay.
Yes, Sanjeev, maybe you can unmute or maybe Madam.
Yeah, Sanjeev, go ahead. Sanjeev? Sanjeev Bajaj?
Yes, sir. Yes, sir.
Go ahead.
Yeah, there is a discrepancy. So it is immaterial. The reason for which it is discrepancy is there.
No, whether it is a discrepancy and you would be reporting or not.
Yes, reporting, no?
Yeah. No. So, okay. So I would just answer it in different way. Now, one need to understand few things. On a quarterly basis, when an inventory reports are submitted to the banks, okay, those are basis the management account. Yes, the discrepancy should not be there, but at times various subsequent adjustments like valuation error or some basic errors, etc., which is not very material. Okay, that need to be considered and factored, because practically whenever on a monthly basis. However, the most important part is one need to understand. If there is a system, company is following the policy, company is doing a monthly closure, and if the numbers which are reported to the banks and the numbers which are reported in the system, if they are different, then definitely you need to report. But if you see that the numbers which are reported to the bank and the numbers which were in system are same, and the subsequent adjustments which are done, those adjustments are in the nature of a lot of audit adjustment entries, etc., then, and it's not material, etc., then one can take the materiality call wherein it's not material. Okay.
Okay, sir.
Okay, thank you.
Chandan, should we plan a break after this point? Maybe it's 5.
Yeah, after this point, we can take a 5 minutes break.
Because it's just half time, so that we can have a quick human break and then come in 2-3 minutes.
Yeah. I think so. We can complete this particular point because I think the poll question was related to this. Correct. And we discussed, deliberated a lot of things. So overall, if you see, currently there were no disclosures on this item. Okay. The amendment suggested that if company has taken a borrowing and company are providing the inventory and various other items to the banks, and if there are differences, then it need to be disclosed, and that whenever they do a disclosure, they need to give a summary of reconciliations and reasons for material discrepancies. The material word is being used in the Schedule 3 itself. So accordingly, you need to give those details in that case. Okay. Key considerations for us as an auditor is whether an entity is still obliged to give disclosures in case there is no outstanding balance at the reporting date. Anyone want to put on the chat box? Yeah, someone raised hand. You can go ahead and speak. So if company had borrowing throughout the year, company were giving the statements to the bank, etc., the disclosure would be required. Okay. But if company don't have any transaction throughout the year and no loans throughout the year, then it's not required.
The origination of this point is, and this is covered in the guidance note as well, that the requirement is that if you have a sanctioned working capital limit, so for example, if your client has just sanctioned something from a working capital perspective, and in that agreement, it is stated that you have to, as a requirement or as a covenant to your loan facility, you as the company will have to submit monthly or quarterly statements. Then in that case, even if you have not availed those facilities in terms of actual borrowings, or if the borrowings were there throughout the period and not there at the year end, still the point and the disclosure would be required if there are mismatches. Similarly, again, there's an interplay with CARO here. Even in CARO, this needs to be disclosed, whether yes or no.
Yeah, so it's 5:04 right now. We can come back at 5:10. Okay, we just take a break of 6 odd minutes. Perfect. And meantime, I'll respond to all your queries, what you have specifically mentioned in the chat box. However, there were several queries posted. We have responded to all those queries. Now, balance for the chat box, we'll do it in next 1 or 2 minutes. Rinkesh, you can speak once we join back. Okay. Thanks, Rinkesh. We would start our session again. Hope everyone is back. With regard to trade receivable, okay, similar to trade for trade payable, similar to trade receivable, only two things which are different. One is an MSMED disclosure, and second is the aging bucket, what is required, which has been specified in trade payable and receivable are different. Otherwise, the issues what are there are same. The items what we discussed are near about same. Okay. Just give me a minute. Some issues in sharing the screen. Okay. What I've done, I have answered all your questions and in the chat box or in the question mode. If you have anything more, you can just put on the question tab or on the chat box. So if you see overall, other than the last point, which I will discuss in detail, all the key considerations which were there for trade receivable are same for trade payable. However, in case of trade payable, as all of you are aware, there are a lot of expenses, accrual, clearing account, other provisions for expenses, what need to be done. So aging report for that is also required and need to be disclosed in the financial statement. Okay. Now I will go to the next slide with regard to disclosure, with regard to ratios. So this is a new change where a significant effort need to be put with regard to this, wherein earlier there were no disclosures required. Now, if as per revised amended Schedule 3, if there are changes more than 25% as compared to the preceding year, a disclosure need to be given for current ratio, debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio, trade receivable, trade payable, net capital, net profit, return on capital equipment, return on. These are the items specified in Schedule 3 itself, and hence every company need to disclose all this if it is applicable. If it's not applicable, then it's fine. In addition to this, the ratio need to be defined in the financial statement, how you are calculating those items. For example, in current ratio, what are the items you are adding? What are the items you are not adding? What is numerator? What is denominator? Debt service coverage ratio is a fancy ratio where all the details, how much interest you are taking, what are you doing for finance charges, what you are doing for lease payments, etc. All those disclosures need to be given. And further, with regard to each ratios, what should be the numerator, what should be the denominator is specifically mentioned in the guidance note, which has recently come up. No gap information is now required to be provided in financial statement. It will further enhance the transparency and increase the understanding of the financial statement. The ratio disclosed should assign to the ratios presented in other documents. For example, there is a listed company giving ratios in the publication, in IPOs. Okay. I think so. Does group compute relevant ratios for purpose of management reporting? It need to be same. Otherwise, the ratios which are given in the management reporting and in the financial statement different, an issue. Does the group include lease liability as part of borrowing for computing ratios, including debts? You need to explain if you are covering. If you are not covering, you need to explain. Most important, for the listed companies or companies having debt, etc., the ratios which are presented in the financial statement and the ratios which are seen by the bankers, etc., from the agreement perspective need to be aligned. Otherwise, there can be an issue. Madam, poll question number 3. Good. We could, on this poll questions, I could see more participants responding. Okay, we have, I'll just end the poll. So 90% people believe, yes, we can give, yes, you can give additional ratios in the financial statement if you believe that it gives a better picture, better clarity, and gives a more informed decisions to the shareholders, stakeholders, etc. Yes, there is no hard and fast rule wherein only these ratios should be given. Okay, you could see, Harsh, you could see the poll sharing what I've done to the candidates.
Yes, I can see.
Okay, thank you. Okay, going to the next, which is in short, we covered in the earlier part, but here the more disclosure is with regard to utilization of borrowed funds and share premium. Okay, earlier there were no such disclosures in Schedule 3. Now, whenever the company has borrowed, disbursed the funds, and the funds were used intermediary for the understanding of shall loan, invest, guarantee, provide security, ultimate beneficiary, the following disclosures need to be given. If you understand this from a FEMA perspective, if the fund is coming from outside India, this becomes very crucial, and whether a loan which is taken from outside India, whether it has a premium related disclosures, etc., it need to be done. I would say there is no specific format, and we see a lot of less companies at a small scale corporates. This would be applicable. This would be applicable where a lot of fancy things has been done. Funds coming from outside India, it is issued at a premium. All those disclosures need to be given. So I would say hardly 1 or 2% of the companies, this disclosure would be required in detail, not for most of the companies. Okay. Now, a key consideration from an holding company to a subsidiary company, whether a clear documentation with regard to the premium and not premium is being maintained, disclosed. So appropriately, it can be taken care. Madam, let's go for poll question number 4, and post poll question number 4, which I will cover. Then I would request Harsh to take up the next slides. But before that, if you have any questions, you can start putting on Q&A or chat. Meanwhile, whenever Harsh would do his presentation for the next few slides, in next 40 odd minutes, I will try to answer the Q&A and the chat questions. So that role we can play, Harsh.
Sounds good. So maybe I can put up my screen.
No, I will complete the poll and then you can do so. With regard to this poll questions, I'll just explain broadly, and I think so then Harsh will take up, because the next topic is on CBAP, and there I think so a lot of efforts and questions will come. I could see only 24% participants has participated in this poll. Let's see more. 28%, 29%. Only 66 people has till now attempted the poll question. Okay, in 2 seconds, I will just close the poll. I'll share the results. So if you see, 94% people believe that the update would be an estimate judgment and not as provisional plan, and you are correct. If there are changes in the original plan, that would be considered as an update and not a fresh original plan. With regard to this, a further more detailed discussion Harsh can take up. Before that, if anyone have any question for the items which is covered till now, please raise your hand and you can ask the questions. And meanwhile, Harsh, you can put up your presentation from the next slides.
Yeah, thank you. So my screen is visible.
Yes, sir.
Harsh, your screen is visible.
Perfect. So maybe without wasting much time, I'll start. And thanks for being a wonderful audience so far. So keep participating. Yeah. So the next point was about the CWIP and intangible assets under development. So you can see on the right hand side, this is the disclosure that is prescribed, whether the projects which are under CWIP, what is the aging of the such projects. And also we'll have to give a separate disclosure for those projects which are temporarily suspended. So now what do you mean by a temporary suspension of projects, or in this case, sometimes there are significant delays in completing the projects. So in case of manufacturing companies or in case of various other companies where a lot of capitalization activity goes on, CWIP is a normal phenomena. And we have also seen that generally sometimes because of various reasons, there are some delays in the capitalization of such assets. So this clause was introduced largely to have a lot of more focus on the utilization of the funds, in terms of if some capital commitment has been committed by the company, whether such commitments have been appropriately completed or not. So very important, and some companies are facing challenges in terms of if actually there are certain things which are beyond, say, 1 year, 2 years, 3 years. So this raises a question in the minds of investors that what is the problem in such projects? Is there any impairment requirements? Because if for example, it's an intangible under development and it is taking 2-3 years to develop, what is the future viability of such expenses which have been kept under the balance sheet? Some of these are very critical analysis and critical considerations that we as auditors should also take care. So earlier there was no requirement of such aging schedule. This is a completely new requirement, and companies now will have to bifurcate between projects in terms of bucket the CWIP in various projects to which it pertains to. And also from a documentation perspective as well, there need to be adequate documentation, maybe approval from the board in terms of a total capex project-wise approvals of what is the amount that is envisaged to be expensed out, and what is the amount that is envisaged to be incurred for such capital projects should also be documented by companies. From a practical side, it is so possible that some smaller companies or MSC companies may not have such documentation in place. But we'll have to encourage our clients to, from going forward onwards, we'll have to encourage our clients in terms of maintaining such documents in terms of what is the summary of the total purchase orders which are committed, maybe, or what is the summary of what is the total commitment for X spend or Y spend. So these are certain considerations which we'll have to now look forward towards giving these details. Again, typically the management will have a problem to talk about suspensions. Sometimes there are legal requirements also. Sometimes there are various agency approvals also which are required for making some changes. So even practically we have seen that these are some of the reasons which the company gives where there are delays or suspensions. Moving ahead on some of the key considerations, practically we'll have to check how the CWIP aging is extracted. Suppose there's a system, for example, a tally or a ERP for that case. So how is the CWIP aging maintained? How is it extracted? What is the authenticity? At what date should be the first date be considered? Whether it should be the first GRN where the first item in the CWIP was entered in the books of the accounts, or whether when it was ordered, what should be the date? These are all practical questions which we have faced in the past few months. But then obviously you'll have to have a policy in place wherein what is the date that we should look at. From a control side, again, adequate controls should be applicable, should be kept in place by companies where IFC is mandatory, wherein what is the frequency at which the company checks whether the projects are completed or not completed, at what stage they identify whether those are suspended or not suspended, are some of the questions that one needs to answer. Again, documentation of the original completion timeline as an envisaged completion timeline is also important. And like I was mentioning, some companies do have or may have an issue that such cases are not documented well in advance. So again, a habit issue that we'll have to force our clients or start pushing our clients in terms of telling them that these documents are now mandatory, because everything will go in the financial statements. So a lot of process improvements are also required going forward. Again, what is the process to identify how and which project is a suspended project or not is again critical. So sometimes in companies we have seen that there is a separate department, a projects department, or maybe a separate department in the purchase function wherein, or in the plant function wherein they will be responsible for a particular project where there is significant capitalization. So as an auditor, it would be important to have these discussions with non-finance heads also in terms of understanding what is the reality, ground reality in case of some projects which are, say, suspended projects. Any questions here on CWIP before we move ahead? Some issue in the screen. Yes, Siddharth, you want to ask something?
Am I audible?
Yes.
What would be the intention for the CWIP aging? Because we are already giving the utilization of loans and advances and that sort of a thing. So what extra would the CWIP aging do? If you can just put something on that.
So consider yourself to be an investor and you have invested something and you find that say 500 crores have been kept in a CWIP, for example, for 2 years. So any asset will earn returns when it is put to use, logically. So the intention of law here is that if something is not going in the appropriate manner. So for example, this project was supposed to start. Consider a big company investing in a, say, a industrial area where the company is going, they also have some tier 2, tier 3 partners which they are following. And there are some government issues, some regulatory issues. And we have seen, I cannot take names, but this happens, right? So in such cases, sometimes there is a project which is not kicking off. So this can be a very critical information for the investors that their money is stuck, for example. Consider a company doing development in intangibles, wherein suppose they have some product and they need some R&D for the development of those products before the product is available on the shelf. So typically say this is a 2 or 3 year process. What if the amounts are locked in such projects which are not going to kick off in the future? So this is a clear cut charge to the P&L. If it comes to the P&L, obviously profits will go haywire. So the company then tries to play with those numbers, keep it in save. So anything in the aging bucket higher than a year is a clear red flag and an indication that something is not correct.
So ESL would also, we would also, try to make provisions here if at all the CWIP remains.
Absolutely. I was talking about impairment, and this is a very good trigger in terms of you should see the recoverability value of these assets. So for example, if it's a regular process, if the company takes, say, maybe it's a capital intensive project and it takes, say, originally 2 years, something like 2 years shooting up to 2.5 years is reasonable. 2 years shooting up to a 5 year is not reasonable, right? So you will have to go for impairment testing for the old ones and for the aged ones as an auditor.
Okay, thanks.
Yeah. Anyone else have any questions, or we move ahead? So you can continue your questions on the chat box as well while we move ahead. The other point that is on the cards is on the relationship with stuck-off companies, and we were discussing this in the when we started, that practical question arises about how do you identify, how does anyone identify whether a company is a stuck-off? Or even let's go to the background. What is a stuck-off company? So you would have heard in news that there are many shell companies, some transactions happen, people with malified intentions use such layers of companies or shell companies or coca companies, what they used to call it, as to do many things in terms of routing many transactions in such a way that it is very difficult for anyone to find out the root or the cause in terms of how funds are misappropriated, etc. So a stuck-off company can be any company where the name of the company is stuck off by the registrar of the company where it is registered because of various reasons. A simple reason can be if you have not filed your annual accounts, the company can be stuck off by the ROC. And there are various other implications as well in terms of how a company can become a stuck-off company. Now, why this requirement? This requirement came up specifically just to see that whether the company is dealing with such companies, whether your client is dealing with any companies which is stuck off, and then this disclosure will become a public disclosure wherein, suppose, consider a case where a company has more than say 50% transactions with such stuck off companies. So this itself is a very big indicator that something is not correct, right? Coming to the practical question of how do you identify stuck off companies? So I'll tell you about the process. So every ROC publishes a set of companies which they have stuck off from the registrar. Such details are available on the website of such ROCs. To take an example, ROC Mumbai, ROC Pune, etc., and various other ROCs who are having companies registered with themselves, publishes a list. Now the practical problem is that this list is maintained in PDF on the website. It is very difficult to electronically use smart functionalities such as Excel, etc., VLOOKUPs to find out from the database in terms of which is the exact stuck off companies. Some other practical problems that we faced were sometimes the company's name is in a short form, say XYZ Private Limited. Somebody will write XYZ PVT Ltd. So it's very difficult to find out whether the transactions are there, because again, data would be huge. And when you are evaluating, or when the company is evaluating for making such disclosures, they will have to run through the entire transaction dump of the year. Again, if the volumes are huge, they will have huge volumes of sales, purchases, etc., running into number of Excel lines. So again, something smart will have to be developed here. Again, this is very new. We could see some vendors offering an Excel list, which they would have converted these PDFs available in various, whatever 30, 40 ROCs across India into a smart readable Excel usable format. And then that document was then used to smartly see through Excel and other Microsoft functions whether such transactions are there or not. Somebody was asking whether only a management representation would suffice, and we were discussing that this is not only management representation will not be sufficient, because no company will say that they have a transaction. Even if the company do not have any intention, knowingly or unknowingly, they may have some transactions, because as a routine process, no company today has any checks in terms of unless it is a very big name, very big fraud which has happened. No company will even know that, for example, for a procedural matter, for example, if the company where some purchases have been done from, say, A Limited, and A Limited have not filed their annual records, so technically then they will become a stuck-off company. But then if there are transactions, disclosures will be required here. And similar disclosures will be required from a auditor standpoint, wherein CARO will have to specifically say whether yes or no, whether transactions are there or not there. So as an audit procedure, you will have to check various items where possibly the transactions may happen. Sale and purchase are classic cases, but even there, otherwise, whether any investments have been made, or whether from a closing balance perspective, are there any outstanding balances or not. All these items are required to be disclosed in this format. Somebody had raised hands. Anyone wants to talk? I could see some hands being raised. Maybe if I have covered, fantastic. Otherwise, you can unmute yourself, or madam, you can help them in terms of coming up with their questions. Some of the practical challenges we were already discussing. There is no database as such of stuck-off companies at our central location. And but since this is a common requirement now, and people will have to follow a function, this database may be soon available. From a company perspective, it would be a very good idea to identify stuck-off companies in the vendor master only, so that even if one has to look at from a control standpoint, such transactions can be avoided at the very source of the transaction. Where suppose in a good ERP, if it is mentioned that this XYZ Limited is a stuck-off company, the ERP system will not allow that transaction to be recorded in the books of accounts in the first place. Yes, Narendra, you have raised your hand.
Yes, sir, good afternoon. What if I have entered into a transaction in the first half of the year and the company has stuck up after in the second half? So absolutely. Shall I report it or not?
Excellent question. So again, practical question, you are right. Sometimes I'll add on to this example what Narendra wants to say. So in a practical case, say ABC Limited was a limited company till 30th September 2021. On 1st October, they applied to the ROC Sumoto to say that now I want to convert to a LLP, for example, and I want to remove my name. I have not done any bad. So A Limited will go to the ROC, they will by default stuck off their name. So again, this is a very excellent example of practically how will you deal with. Honestly, there is no answer, but you can decide about if the company was not a stuck-off company, you can give a footnote disclosure or something like that in such cases where say it was a conversion, or suppose the company, but if the company continues to be a company and they have become a stuck-off in the second half, obviously there would be some balances or there would be some closing balances. So in such cases, disclosures will be required.
Okay, thank you, sir.
Do we have any other questions? I am not able to see my chat right now because maybe presenting and then replying is not making sense? Maybe we'll reply it later on, or maybe you can feel free to raise your hands and ask your questions. So moving ahead on the next requirement. The next requirement is about loans and advances. And again, as a practice, there's no, so currently these disclosures with related parties are made in the financial statements. So any loans or any advances to directors or firms, private limited companies where the director is a partner or a director is already made even in the current era. Amendment to Schedule 3 here talks about specifically whether any loans are granted to promoters or not. So promoters, directors, KMPs, and any other any other parties who are severally liable. And also it talks about the mode of the loan in terms of the modus operandi. Sometimes the loans are given in such a way that there are no terms attached to the loans. It's just a loan given to a promoter, for example, because again, there is an override. Promoter himself is managing the company, so it's very easy for him or that promoter to say give a loan from the company on a personal account, for example. So in such cases, there are no terms attached to a loans, or sometimes the loans are repayable or demand. So such cases now are required to be disclosed along with the percentages of such loans to the total loans given by the company. So for example, if the company has given a loan of say 1 crore, and out of that 1 crore 80 lakh is given to Mr. Promoter, again with without a term being specified. So this will again now be flashed in a bold and capital letters in the financial statements, that, and it would be very easy for a smart investor to check whether, okay, this is a loan to a promoter. Again, 80% of such loans are made without even specifying the terms, right? So again, onerous disclosure. We'll come to CARO for this. Again, as an auditor in CARO, a lot of things needs to be spelled out independently by the auditor. So again, it has an overplay here, but this is something which has come up new as a requirement. While I was talking, I could see some hand which was raised. So Rajiv Bhagwat has raised the hand, and you can please ask a question.
Sir, regarding the transactions with struck-off companies, if the transaction is closed, I mean, if the sale is done and money is received and there is no balance, still it is to be reported on only if there is a balance. Yes.
So it talks about a transaction. So there are two requirements. A transaction should be there, and it is possible that there is a closing balance as well. So to answer your question, if there is no closing balance, but there was a transaction somewhere during the year which is closed, and the company was a struck-off company, still a disclosure is required.
Okay, thank you.
Yeah, this is made clear in the guidance note as well in terms of specifically giving such disclosures.
Okay, thank you.
You see some more participants raising hands. Please go ahead.
Yeah, Harsh, I mean, would the same apply for the loan, because it says the nature of loan outstanding. So there would be a lot of, normally there are a lot of transaction in the promoter's account. So so I mean, at the end of the year, maybe the balance would be 0. Okay. Now the requirement here is only for the outstanding loan. So if the balance is 0, so would it still require any disclosure?
I would still go with the spirit of the act, wherein now the requirement is such that whether the company was struck off or not in the first place, and is your company where you are the auditor is having any dealings with such companies or not. So even if the loan balances have been squared off, such disclosures would be required, because it also talks about transactions. One may say that this is a loosely worded requirement or something like that. But going to the spirit of the act and requirement, I think it would be required.
Yeah, no, this question was regarding loans and advances to the promoters.
Okay, I thought you were talking about the struck-off companies. Okay, sorry. Okay, so you are saying that whether the loans which have been repaid during the year.
The requirement here is to only disclose the loan outstanding, maybe at the cutoff period. Okay, I mean,
correct. So in this clause, correct, you have to see the closing balances of loans.
Acha. So if at all there are a lot of transactions in the account during the year, because again here the spirit question comes into place, because there might be a lot of money which gets.
It is so possible that the smart promoter will take a loan, repay it on 31st.
Yeah.
Right. So So again, going to the spirit, then even here, maybe you can say 0 and give a footnote to say that such and such loan was given on such and such date, and again repaid by them.
Yeah, because the question still remains is whether these are loans or, I mean, should you treat them as loans or not? Because these are normally, you know, temporary requirements for the promoters. So, I mean, terming it as a loan, I mean, I would like you to.
So again, I'll touch upon one more topic. When we come to CARO, we'll discuss in detail. So in the CARO clause, it says that loans or any advances given in the form of loans. So what are advances given in the form of loan? So again, here there is a discussion debate that, so if it is a customary advance, for example, if you're buying goods and services, and it is customary so that you give us a 30-day advance to a party, then this is an advance in the normal course of business. Suppose Mr. Promoter is drawing money here and there in terms of without any specific reason, or if it is not so customary in that entity or in that nature of business to give advances, then it is clearly misappropriation of funds, right, from a company standpoint. So again, going to the spirit, this would be required.
Because, you know, normally you would also have, you know, these travel advances which goes to.
Then it would be customary. Yes, if there are travel advances and traveling is so required for the business of the company. But again, as an auditor, you'll have to judge. Travel advance can be, say, a few lakh rupees, for example. It cannot run into, say, crores. And even the company then telling you that as an auditor, this is a travel advance, or this is this is an advance for X purpose. So you'll have to apply judgment and also see the values involved in terms of whether it is making sense from an overall standpoint.
No, but this advance needs to be reported, right?
Yes, the advance needs to be reported, which is not in the normal course of business.
Achha, the customary would
to
not
answer
get
your question specifically, travel advances will not come, but any other loans or advances, which is loan in the form of a loan, or advance in the form of loan, will be covered.
But how do we treat them as a loan is my basic question, because you know, the schedule itself says, because these are not you know, any specified terms or period. I mean, there are no agreements as such. So how do we treat them as loans?
So then why? So what is the intention of the money being going out of the company to a promoter if it's not a loan?
And that needs to be reflected, because, you know,
Absolutely
normally.
right. So here again, there is some red flag, my friend, in terms of if some advances are given and then later off squared off again. So again, from an overall sanity perspective, also companies' funds have been used for non-business purposes in that case.
Yeah. Okay. Thanks.
Right. I could see one more hand. That time, is the question answered, or you want to? No, maybe we move ahead, and if there are any questions, we can take it. So this talks about the corporate CSR provisions, which we could see some changes even in the last year. And from the time CSR was introduced, there were a lot of changes. To start with, it was not mandatory earlier. It was only a disclosure till a certain point of time. And now it is, in a way, has become a levy or a similar function where those companies who are making profits are now mandatorily required to spend some amount, and that is 2% of your average profits and the CSR expenses. So now, from a new reporting perspective, the company will now have to specifically in the calculations and in the notes to accounts disclose what was the amount required to be spent by the company. And again, there would be a calculation backed up by the 2% of the average profits of 3 years, and then for the profits there's a formula given in the rules. So this amount should be disclosed now in the financial statements. Against that amount, suppose that amount is say 100, what amount is actually incurred by the company? Suppose the company incurs only 80 rupees. So 100 rupees is the total amount that is required to be expended. 80 rupees is what the company has expended. Naturally, 20 rupees is a shortfall. These things are required to be disclosed in the financial statements. Again, what is the shortfall of the previous year? What is the reason of the shortfall? All these things are now required to be maintained and publicly disclosed in the financial statements. Earlier, there was a director's report covering the CSR, wherein the CSR committee and various other disclosures were there. These requirements have also been moved up, wherein some more additional disclosures will be required to be done by the company. But even from a financial statement standpoint, a lot of new requirements which are mentioned here are required. Again, what are the nature of your CSR activities needs to be done. If there is a related party who is doing a CSR activity, even that needs to be disclosed, because many companies have made their own foundations. In terms of, if your client is a XYZ Limited, they will make a XYZ foundation, which is say a trust, and that foundation will then do a CSR activity. So even those transactions, and this is a related party to your company, needs to be disclosed. Again, a provision is now required to be created where there is a shortfall. So the Act now talks that if there is any shortfall, so you have to identify what is the reason of that shortfall. So there are two things. Either it can be specified to a project. So for example, the company may decide that let's make a school. So this making a school in a backward area, for example, for the benefit of the entire society, is a CSR activity, and building this school is a project. It can be funds can be demarcated for those projects separately, and on the other side there would be some funds which are not identified for any specific projects. So now section this is CSR section, which is 135 if I'm not wrong, needs the company to deposit this amount in a specific new bank account, specifically termed under the CSR, something similar to a unclaimed dividend account or something like that, within a specified period. And whether this is done by the or not is also required to be reported in the CARO report. So these are the new requirements of the CSR which has come up in the revised schedule. I could see some hand being raised some time back.
Hello.
I believe, yes. Go ahead.
So the CSR applicability to a private limited company, can you brief on that?
Yes. So okay. So talking about that section to any company, the section says that if you have profits in the, let's say, last year, so that is a trigger point. So in the previous year, if you have profits, the requirement says that you have to form a CSR committee first. That CSR committee will decide what is the purpose of and what is the amount that needs to be spent. The calculation that it needs to be done is on the basis of last 3 years average profits. Okay. So basis the last 3 years average profits of the company, 2% plus or minus. There is a detailed formula which you can go through later on, which then talks about what amount is then required to be spent.
So the trigger point is some minimum requirement, na, sir? How much profit that would be?
Trigger point is profit in the last year, and there is some threshold to it. Yes, I am not able to recollect the number, but the trigger point is first you have to form a committee as soon as there is a profit above a specific threshold. Okay, what else? Any other question? Maybe we move ahead to the next question about lease liabilities. So about the presentation of lease liabilities. So there were two things earlier. So some companies had a habit of disclosing the lease liabilities on the face of the financial statements. Some people were disclosing these as borrowings. So now it has been clarified in the revised Schedule 3 amendment that lease liabilities is not a borrowing, and it has a different flavor altogether. So it should be disclosed on the face of the balance sheet. Some more clarity that is given here. So we have a poll. Can we have the question, please? So whether lease liabilities needs to be considered as debt for the purpose of debt equity ratio. So we have good 70+ responses so far. And it is going neck to neck, 49%, 51%. So for yes or no. Maybe we wait for a few more seconds before we stop the poll. All right, maybe we can now publish the results, ma'am. So I can see the results. Yeah. So roughly 100 people, and what are neck to neck result? 51% says yes. Lease debt, the lease liability should be included as a form of the debt equity ratio, and 49% people are saying no. So quite a mixed response here. But so when you see what is debt, so debt is anything which the company has to repay someone, right? So technically, if and again there is no right or wrong answer, but technically from a debt equity ratio, it should be only be pure debt to say any lender or bank or financial institutions. The lease liabilities are commitments towards your future usage of your right to use assets, right? So one may argue that it doesn't form part of my total debt and need not be included as debt when you calculate the debt equity ratio. All right, maybe we move ahead. Again, new disclosure for the promoters shareholding. Many promoters. So generally this requirement came up because there were layers of companies. Nobody knew who was the actual promoter of the company. So now if there are layers of company within the group and suppose Mr. X is the promoter. So now there's a new requirement that the promoter's name or the ultimate holder's name should also be disclosed. Yeah. There were some requirements for listed entities where both the promoter and promoter groups were required to be disclosed for as per the SEBI regulations. But now amendment to the Schedule 3 has made it limited to the promoters only. But the intention is again clear. We know who is backing this company, who is the promoter of the company for various reasons. Number of layers of company. Again, like I was discussing earlier, some companies who have malified intentions may or may not have malified intentions, but the structuring is done in such a way that there are multiple layers of companies and the transactions are somewhere lost in terms of A to B, B to C, C to D, and so on. So now again there were some rules also which were there in place. So not more than 2 companies, 2 layers of subsidiaries were allowed. Now even from an amendment perspective, the name and the CIN number of the company beyond the specified layers needs to be disclosed. So in other words, a contravention is now clearly being reported, in other words, in the financial statement itself. Again, the main intention was clamping down the companies which are involved in siphoning and other malified activities. So these were a few critical ones. I will quickly cover those again, which are again a requirement, but you may or may not come across such situations. So details of any properties held by a company under the Benami law. If your company has any Benami transactions or any Benami properties, then again such disclosures would be required. A very important consideration is, as an auditor, how do you know whether that company or that promoter or that party which you are dealing with has any Benami transaction? So again, a tough one, but from an audit standpoint, you can check whether there are any tax assessments. You can check if there are any notices, search, seizures, etc. being done. The next requirement of undisclosed income is also something similar, where how do you as auditor will come to know whether there is undisclosed income or not. So a very tricky one, but again, tax, you can go to tax assessments, tax laws. Finally, if you find anything, the implications are there in Ind AS 8 or Accounting Standard 5, which talks about prior period errors. And then obviously if there's undisclosed income, etc., those transactions will have to be reported. or you will have to consider the effect of the prior period errors, etc. in your report. Moving ahead, revaluations. Again, earlier revaluations were made rampantly. There was no specific guidelines. Now, as per the revised amendment, if you are doing any revaluation, you'll have to do that on the basis of a registered valuer. Okay, under the company's registered valuer rules. So again, some regulation has been put in place. And if there is more than 10% revaluation, you'll have to explain that. Similar requirements for fair valuation of investment properties. Registered valuers will have to be appointed by the company, and then only such disclosures will have to be made in the financial statements. Section 8 companies will have to now disclose grants or donations which are received. Again, there were no such disclosures earlier. If your company or client is dealing with cryptocurrencies or any other virtual assets, this disclosure will be now required to be made in the financial statements. And any profit or loss which is made on account of such currencies will also have to be disclosed. The next one is a very interesting one about willful defaulters. So now, the moment there is a willful defaulter, we have a very famous, or we have few famous names which comes to our mind, Malias of the world. And but now this is now a requirement where if any willful defaulter, or if your company is considered as a defaulter for any say non-repayment of a loan, etc., this will now be required to be declared, okay, and commented upon in the financial statement in the first place. And again, here we have an interplay with CARO, where with CARO, you as auditors will have to say whether your company is a willful defaulter or not. Now, a very important question here: how will you as auditor come to know whether your company is a willful defaulter or not? And maybe by raise of hand, if someone wants to pick up this very logically, how will you determine? Because your company will never say that I have defaulted in XYZ, or I'm a willful defaulter, or I'm not a willful defaulter for that case. Anyone want to give a try?
Hello, Harsh.
Yes, please. Yes, Mr.
I want to just some slides back. You said that leased liability is to be disclosed in the balance sheet.
Correct.
So how that will come in the books?
Okay, so lease liabilities, as per there is a new standard, AS 116, which talks about recognition of ROU asset, right to use assets, and recognition of lease liabilities.
Okay.
In such cases, you will have to bring the lease liabilities in the financial statements.
Harsh, sorry to interrupt. Narendra.
Yeah.
That particular disclosure is only required under Ind AS financial statement, not applicable for IGAAP.
Not applicable for
IGAAP.
Okay.
Okay. I hope that helps.
Okay.
Yes. Thanks for clarification. Right. So we were on willful defaulters. Anyone want to pick up this? How do you identify as a willful defaulter? So we could see some hands which have been raised. Go ahead, please.
Hello.
Yes.
Am I audible?
Yes.
Yeah, if there is a default, prima facie every default should be considered as a willful defaulter, and it should be up to the management to explain that why it is not a willful default.
So, okay. So to make it more clear, you are saying that whether even a smaller default, say a loan repayment.
So the onus will be on the management to say that why it is not a willful default.
Correct. And plus there are other agencies also. So for example, if there was some default, so again, there is no clarity. There is no clarity officially, but then you will have to apply your judgment in terms of, take an example, if the EMI was say defaulted for say 5 days or 10 days, whether it will be a willful default or not is a question, right? So sometimes even
all lapses may not be considered as willful default.
Right. If that
delay by some days which are then met out, and if it is not normally habit to delay the payments, but some few incidents of happening a small delay, that may not be considered as a willful default.
You're
But
right.
material amounts, if there is material amount of default, then it should the company should management should come and explain why it is not to be considered as a willful.
Right. So I would maybe I'll just clarify. The requirement is that whether your company is declared a willful defaulter by a bank or a financial institution or any other lender. So to take your example, if the company has defaulted in a say a monthly payment and they have been charged penal interest as well, and say after say a month's time they have corrected that default. So it is up to the bank or the financial institution or that lender to declare this company as a willful defaulter or not. So there are forums and maybe even sometimes this information is available on the bank's website, whether if they have considered particular entities as willful defaulters. So they publish that list. So that is one source. The other source can be like you take a bank confirmation for the bank balances. You can also take a confirmation from that bank where there is a relationship or a loan from by the company to specifically comment whether the company is a willful defaulter or not. Plus, there are certain other agencies you would have heard of CIBIL, wherein CIBIL publishes the credit score. So even there, if an entity is a willful defaulter, it is a very good mechanism to find out whether the dealings of the company are somewhere close to any willful defaulter.
Thank you.
Okay, moving ahead.
Considering time, is it possible that we take all the questions at end? Anyways, we have a Q&A at end.
Yeah, perfect.
Thanks.
Perfect. And maybe we don't have much slides. We can just, others are common requirements. So again, some specific disclosures in the statement of changes in equity where any prior period errors now needs to be disclosed. Specific requirement. Again, if the title deeds are not in the name of the company, this needs to be disclosed. So it can be a particular case of say a change in hands of the property and the property names are not registered in the name of your company. That can be a classic case where immovable properties are not in the name of the company, or maybe there can be some dispute with the previous owner or something similar. This now requires a disclosure in the financial statements before you can give this disclosure as a footnote in the schedule of the property plant equipment. Again, registration done for satisfying of the charges or not. If the company has not done, for example, if the company has taken loans and given some mortgages, and these mortgages now needs to be registered with the ROC. So whether such registration have been done appropriately or not within the time is required to be disclosed in the financial statement. So the intention here is if you are writing it in the financial statement, you will have to see whether it's correct or not, right? So that's the whole logic of adding various such. Even it may sound that these are small disclosures, but very critical ones if in case there are disclosures. Again, some clarifications on current maturities of long-term borrowings. Again, these have to be now disclosed. Earlier, the requirement was it was disclosed under other current financial liabilities. It is now disclosed as a short-term borrowing or a long-term borrowing. Security deposit is another example where now it is required to be disclosed as a financial asset. Some more functional changes in the rounding of criteria. So basis the current practice is that it is rounded off basis the turnover, but now it can be rounded off on the basis of total income or revenue from operations. We have a poll question now, maybe.
Rekha ma'am, poll question.
Yeah.
Thanks.
So whether the disclosures which are required in the revised schedule 3 would be given in a tax financial statement. So just for clarity, tax financial statements are those financial statements. For example, a company has a separate year end other than March 31st. Some companies follow say a December year end. Then a separate financial statement is required to be drawn for the purpose of tax accounts and tax compliances. So whether these are required there as well, 50 plus responses so far, and we wait for say 2-3 seconds more before we conclude the poll. Maybe we can stop the poll now. We have around 90 responses, and maybe present the answers. So 36% people say yes, the disclosures would be applicable in tax financial as well, and some people are saying no. 64% people are saying no. Yeah. So let's see what is the basis of the financial statements when the tax financial statement is prepared. So again, this is an older requirement where even in the pre-revised Schedule 3 era, tax financial statements were mandated for some companies, and there was a guidance from ICAI that certain disclosures mandatorily required by the Companies Act and Schedule 3 needs to be given in these financial statements, but some other notes to accounts, etc., need not be reproduced. So again, taking the genesis of Schedule 3, it would be appropriate for the company to have these disclosures in the tax financial statements as well. Okay, I think we've come to the end. So overall, again, a lot of areas in the financial statements will now have a lot of red flags, which again, the auditor will have to consider knowingly, unknowingly. We will have to see how do we change the entire process of preparation of the financial statements. What are the controls around the financial statements being prepared by the company? Again, a lot of disclosures will require changes in accounting, which we have discussed at length, and sometimes even the changes in the ERP systems or the chart of accounts. So a lot of things on cards. And obviously, this is the first year, so we'll have a lot of learnings. There would be some clarifications also, which would come up basis what are the common practices and all, right? Okay. We could have few hands being raised. Maybe we have put up few questions.
So first, what we do, we complete. So we also have. So what I understand, the Pune branch also has some questions what they want us to address, which are not covered now. We can cover those questions, and then definitely we can be on any additional questions. It's okay.
Yeah, perfect.
Yeah. So Amruta or Rekha ma'am, what's the next?
Yes, sir.
Yeah. So what I understand, there are some panel questions what institute has.
Yes, yes.
Prepared. So we
Yes,
can
I
go.
will ask Rishikesh sir for setting in here, sir. 1 second. Rishikesh sir.
Okay. Meantime, I could see Shekhar was raising hand. Shekhar, go ahead.
Yeah, it's regarding willful default.
Okay.
So what we come across normally, we talked about term loan, but normally in case of working capital also, cash credit limits are not reviewed by the bank for some reason, for non-submission of financials, or most of the time they are seeking additional security or additional limits which the company is not able to provide. Then what happens? It goes on like that, and company banks stop their operations actually in a bank practically. They don't allow them withdrawals. So what company chooses, they operate a separate account in different banks. They open current account, which is not actually legally allowed, but they do that practice. So whether it amounts to willful default.
So before Harsh add, I would suggest if you believe as an auditor something which is not a correct practice is being followed, minimum disclose this in financial statement as a note below the CC, that this particular CC limit has been stopped, giving up appropriate disclosure. So I will tell you, all these disclosures which are coming now in Schedule 3 is for the reader of the financial statement, be it the shareholder, be it the government institutions or various other stakeholders, to understand if there is any issue in the financial statement, issue in the company. Okay, so that particular comment and remarks in the financial statement definitely helps. Now coming back to CARO, I think so tomorrow we can cover that from a CARO perspective, whether anything is required to be reported as an auditor or not. But in financial statement, my suggestion would be go ahead and disclose the fact. I'm not saying this is an issue.
Okay.
You are getting, Shekhar?
Yes, I'm getting. But whether it will amount to willful default, because finally account will go into NPA mode, or it could have already been gone.
Correct. From a bank's perspective, it's an NPA, etc., etc. Correct, Shekhar?
Bank will treat it as willful defaulter.
Right.
Because he is
So
not
here,
operating the account.
maybe I can add something. The requirement is specific that whether your company has been declared as a willful defaulter by any bank or a financial institution. So if the bank is having problem with the company,
they don't say like that. They go on negotiating. But we know he is
so
not.
Shekhar, no, Shekhar, as part of the bank confirmation, when we take from the banks, we should have a specific question on whether this loan is and the company is a willful defaulter or not. And we need to ask bank to comment there. If they comment this as a willful default, we need to report. If they confirms it's not a willful default, we will not have a problem.
Perfect. As an auditor, we should have that document on records from the bank, because tomorrow it is the bank who will raise an issue in terms of initiating proceedings under various, say, if the loan is not honored.
Prashant, yes, bank does that. Bank does that. There is a mandatory requirement for the bank to classify a company as a willful default or not, and we need to ask the confirmations.
And earlier there was no question like willful default. So what they were seeking whether accounting standard or NPA, and they were defining it is NPA or it is substandard.
NPA is a different terminology. Shekhar, NPA is a different terminology. NPA is from a bank's perspective, whether that provision is required or not required. Now we are talking bank classify this as a willful defaulter or not, which is important, because NPA, if a company is paying or not paying, the provision of NPA and the provision for the defaults is basis the total balance and not only on the basis of the willful defaulters.
Yeah, but the account has to be NPA before it is declared a willful defaulter.
Exactly.
No good account will be declared as willful default.
So you know, you got your answer.
Yeah.
Okay. Thanks. Rishikesh, over to you.
Yeah. So before we take some other questions, we have some panel discussion questions. The first one is, what is the definition of total income? It's not defined under any act or schedule. So what are your views on this change?
Okay, good question. So to give a background of a total income first, the first utmost change in the Schedule 3 is earlier in the financial statement. The financial statement were prepared in paisas, in absolute rupees, some in thousands, some in millions, etc. And that requirement was company shall. Okay, now it's must.
Okay.
So from that perspective, knowing the total income is very important. Total income is not defined under Schedule 3. And also total income is not defined very much in the other literature what institute has given, but in the guidance note, the total income is defined, and total income includes revenue from operation and other income. And the disclosure of company being less than 100 crores, the separate disclosures, the company being more than 100 crores, separate disclosures, and accordingly identifying the total income is very important.
Excellent, excellent. There is one more. I think Harsh can take this one. Imagine a scenario of an integrated project. It contains construction of various group of assets having a common intended use. Completion of few of the group assets is behind schedule. However, overall project is as per the original approved timelines. So how should this scenario be reported under, and under which clause?
Right. So this is again, if I believe this is, if I'm not wrong, this is again the CWIP aging and the CWIP.
Yeah.
Disclosure for any delays in the projects or not.
Yes.
So consider an example, and we can take an example also. So a project, for example, a building is being prepared, and that is under CWIP.
Yeah.
So you are saying that floor number 1 and 2 are delayed, but as a overall integrated project, the entire building completion, for example, is well within the timelines.
Absolutely.
So here it would be a good argument to say that the entire building is under the envisaged timelines. So nothing should be disclosed as of now.
Yeah.
In the anything which is delayed, because the entire project is within the time frame.
Yeah.
Yeah.
So there is no need to disclose this.
Yeah. Okay.
So there is no need to disclose.
But obviously, when the entire project will go outside the boundaries,
yeah,
then definitely a disclosure will be required.
Absolutely.
Yeah.
Okay, there is one more. Whether additional note to be provided for the time bar debt in case of trade payables.
Okay.
Is
so
there any disclosure
time bar
requirement?
debts. Okay, so time bar debt is a time barred, I would say time barred act wherein a trade payable not paid more than 3 years becomes a time bar. Okay, from the limitation of law perspective. However, Schedule 3 has clearly give the details of the trade payable and aging less than 1 year, 1 to 2, 2 to 3, and more than 3.
Yeah.
So in a way that we are disclosing the amount which is more than 3 years. And if someone want to interpret whether that's a time board or not, they can. But as a company and as an auditor, I would not prefer to specify further saying these are time bar.
Yeah.
And in that case, there would be a problem to company, because Schedule 3 and the guidance note nowhere covers this additional disclosure.
Okay. So there is an interplay between law and economic laws and the corporate laws.
Yes, yes. And it's so it's better because we need to also understand an additional disclosure given in a financial statement, if it deteriorates the position of the company, should never be given. And if it's not mandated by any of the law, etc., and it doesn't give a wrong picture.
Absolutely right.
And hence additional disclosure need not be given in that.
Great. Yeah, we still have 5-6 minutes with us. I think we can take some questions in the Q&A box.
I see some hands being raised. So
yeah. People are interested in asking questions. Yeah. So
there's a lot of new things coming up. So
absolutely,
I'm sure there were tons of questions.
So there were roughly 20 questions. So there are two options in Zoom. One is question and answer, and there were 20 questions already being raised, and I think so we have answered all of them. And there were few in chat box. Those are also being answered. If you believe we have not answered, or you have any additional questions, we can do through raise the hands, and then you start talking.
Yeah, we start with Rinkesh and then followed by anyone else who still wants some clarity. We can take up. Go ahead, Rinkesh.
Can you throw some light on these 3 divisions in Schedule 3, that is division 1, 2, and 3, with respect to 1 and 2, I mean the monetary limits. So when IGAAP is applicable, when Ind AS is applicable?
Yeah, I can do that.
Okay.
So from an Ind AS perspective, every listed company mandatorily requires the financial statement to be prepared under Ind AS. That's point number 1. Point number 2, if a company has net worth, including reserves and surplus, more than 250 crores for the last preceding financial year, then Ind AS is applicable. And definitely, if an entity is listed, that listed entity, Ind AS should be applicable. So this is a broad category where if company falls under this bracket, then Ind AS is applicable. For the companies who Ind AS is not applicable, they need to follow Indian GAAP. And when Indian GAAP, we mean accounting standard 1 to 29. And when we mean Ind AS, full Ind AS financial statement is applicable.
Thank you, sir. Thank you so much.
Plus, Ind AS is also
go ahead.
applicable to any company whose holding company is under Ind AS. So as a group, you will have to follow uniform accounting policies. So if your parent company is a Ind AS company, and even if your company is say a 10 crore company, still you will have to voluntarily adopt a Ind AS.
Mandatorily, not voluntary.
Voluntary for that company, but for the group it is mandatory. So
for that company also it becomes then mandatory, not voluntarily. It becomes a mandatory from a company law perspective for all subsidiaries, all JVs, and all associate. And thanks, Harsh, for adding this. The definition is specifically, it says group, and the group need to be defined. And group is parent, means holding, subsidiary, joint venture.
Perfect, absolutely.
And I'll just add, as you have asked this question, the statutory accounts of those subsidiary, JV, and associate company need to be prepared under Ind AS for the Indian statutory accounts. But if a company has a foreign subsidiary, for their local GAAP, Ind AS is not mandatory.
Oh.
Right here, what about if the parent is under IFRS and there's a takeover of an Indian company? It is under IFRS. So an Indian company has been taken over by a foreign parent who might be under IFRS or US GAAP. So does it mandate that? I mean, because if you go by the normal thresholds, it might not need Ind AS. So what would happen in that case?
Siddharth, I'll just take up your question. So Siddharth, if a company is outside India and it acquires a company in India, however, in India, to function, they will require an independent company in India. And for that, they need to follow the Indian laws. In that case, even if the parent is using IGAAP, IFRS or US GAAP, still in India, the company need to evaluate whether those three conditions what we were discussing. The first condition, the state entity. The second condition, net worth of the Indian company. And third, the parent should be an Indian company and not parent of a US or a IFRS company. In that case, Siddharth, the net worth of that company need to be evaluated for classifying under Ind AS or IGAAP.
Yeah, but the thing is, just to add here, now since the parent is under maybe US GAAP, now they are insisting that the accounts should be laid under Ind AS. Okay. Now, as an Indian auditor, I would not comment on, or I would not issue my audit report basis the Ind AS, right? I would always issue it according to the applicable, that is the non-Ind AS, division 1.
No, Siddharth, if I understand you very correctly. If, for example, let's take an example, an ABC company in US acquires a company in India. For their US GAAP reporting, which is called as a group reporting, the company will use US GAAP. for an Indian regulation.
This will be a completely separate set of books and separate set of financial statements, if any.
If
nothing to
it's
do with the local financial statement.
Secondly, in this case, the Indian company has a choice. So, okay. So, for example, a company is going for IGAAP. If someone want to voluntarily go under Ind AS, even if the thresholds are not meeting, you can do so.
Yeah, but the question here is particular. So my audit report or my audit would be on the non-Ind AS financials. I mean, they can use anything.
Siddharth, your audit report is on the company's financial statement, correct?
Prepared on non-Ind AS basis.
No. Your audit report is basis the company's financial statement. Company has an option to voluntarily go under Ind AS. In that case, you need to issue an opinion under Ind AS only.
Okay, that was my question.
Company need to decide which where they want to go.
Which gap they want to follow, IGAAP or Ind AS. This is that you will have to give your opinion.
And that too, if thresholds are met, they have to mandatorily go to Ind AS. If thresholds are not met, they can go out. I think so, Rishikesh.
I think there is one more question. Yeah, in the Q&A box.
I would respond to that. Payment of SIP installment for CC account. Do we need to report this? SIP installment, as company is not allowed to open current account. If bank
so when Chandan is replying, anyone wants to ask any question on the by unmuting, maybe Chandan, you can reply on chat in the meantime.
Yeah.
Any more raise of hands or
no? I think so. Thanks. What we do, Harsh, if we have any other questions,
people can think and come up with questions tomorrow as well.
Yeah, we have a session tomorrow too.
We have
before we wind up the session, I request my colleague in the managing committee and treasurer of Pune branch, CA Pranav Apte, to propose a formal vote of thanks for the today's session. Over to you, Pranav.
Thank you so much, both the panelists, CA Chandan and CA Harsh, for this exciting and insightful session. I really hope and I feel so that after listening to these thoughts, there is a lot of work is to be done on the financial statements. But with the help of this particular session, today's and tomorrow's session, it will be really, really helpful for us to actually to prepare the financial as well as to audit the things and make the appropriate disclosures. So on behalf of Pune branch, all the managing committee members, I thank both the panelists and looking forward for tomorrow's session as well. Thank you. Thank you so much.
Okay. Thanks.
Perfect. Thanks for being a wonderful audience.
Thanks again to both of you and the participants. And we'll meet tomorrow the same time, 3:30.
So
for the remaining discussion. Thank you.
To all the participants, if you have any query today, tomorrow after post session, I've shared my mobile number in the chat box. You can WhatsApp me any of your query and definitely I will help you on those queries. And you can also reach out to me on LinkedIn. You can drop me a message. I will respond to on LinkedIn, either of the case. Thanks for that. Tomorrow, okay.
Thanks, there is a separate link, joining link for tomorrow's session. Participants will get the link by 2:30 tomorrow. Okay.
Perfect. Likewise, feel free to connect. Thank you, everyone.
Thank you. See you tomorrow. Bye.
Thank you. Thank you so much. See you tomorrow.
All.
Yeah. Yes, Pranav.
Yeah. Yes. No. I think some of the participant wants to say something.
Siddharth has his hand raised.
Yes, Siddharth. Go ahead.
Yeah.
No. He has concluded. Yeah.
Okay. So
all right.
Just there was a raise of hand, so I was just wondering.
All right.
Okay.
So see you tomorrow.
See you tomorrow. Yes. Thank you.
Bye.
Thank you.
Thank you.